What's up, everybody? Michael Silva here. You're watching the Stock Market Brief Show. This is a weekly recap, and I got some very interesting data to go over with you today. Yes, the market has rallied, and everyone's kind of talking about jumping back in. You have other people telling, why this rally took place. It was because of a lot of selling of puts, because hedge funds, right? They hedge. That's what they do. And then what happens when they hedge is that they have to unwind those hedges when it makes sense to. So we're getting this big rally. They're not wrong. Okay, so we got it's just some interesting intermarket things taking place today. And while everyone's eyes have been on the strong performing oil sector, which, trust me, a lot of these charts look good, I'm still looking at them too. Something very important is taking place under the surface, and I haven't heard anybody talk about it, but I want to point it out in today's video. So it's an important one. We're going to go over many different things today. We're going to go over the risk ranges, right? Those expected moves that we talk about. And we're going to talk about commodities specifically in today's episode. So let's go ahead and get into it. Welcome back to the channel, everybody. First and foremost, starting here at the Wilshire 5000 composite. This chart I posted on a separate video and also on my Twitter. If you don't follow me there, you can follow me there. This is basically looking at all the stocks in America. It's a very good, broad picture of what's taking place in the markets. And technically speaking, this is the most obvious looking, breakdown that we've seen, right? We had this double top with a negative divergence, broke down for the channel. And then we talked about it when it was forming a bear flag as it tested that 200-day moving average, right? This was just based off of technicals alone. We know what happened later on, right, with the news drop, and we started cracking down from this bear flag, and now we're starting to rally based off of, well, a lot of option volume taking place, right? Selling of puts. I'm not going to get into why that can create a squeeze as of right now. Just know that when there's a lot of selling of puts, this could take place. What we don't know, though, is how high it can potentially go and where it could potentially stall out. And we're going to talk about that a little bit more in today's episode, looking at various ranges. Okay, so we had a positive divergence. We're starting to bounce back up, still below that 200-day moving average. If we actually zoom in here, you can see, right, we kind of did that double bottom right here, hadn't had a close below this previous low, and you can see we just came right back up and we're skyrocketing up. So we'll talk about the indices here momentarily, but I want to, people are feeling, and I'm hearing more and more people like, okay, now we're going to start entering back in. This is where it's going to start, the melt up. We're going to start getting in. I know me, Kevin, I reference him every once in a while because there's a lot of people, and the reason why I do, by the way, is there's a lot of people that follow him, right? He's kind of like that, one of the faces of retail trading. And the thing is, I just heard him, I'm getting back into the market, right? And so far I'm doing good, right? On this melt up, 2-day rally right here. The thing is, I don't want everyone to just all of a sudden turn very bullish right now. Yes, it was an amazing rally, but there's still a very large amount of risk in the system. Let's just show you what I mean here. The VIX, it's still in the upper 20s, right? 27.59. So this is not like that warm and fuzzy teddy bear, hug me, I feel good feeling right here. We'll see where it can go potentially into next week, right? If you want to feel warm and fuzzy, let's get back below 15. Let's get back below 20. It's been a long time, and you can see it's clearly trending up, higher highs and higher lows right now. So, if you're feeling like, hey, we're going to go back up to all-time highs, you could be right, but there is way too much risk to feel confident in that bet. Okay, even the VXN, this is the NASDAQ volatility. This is above 30 still. It's above 30. Do not feel warm and fuzzy because we're getting this rally, right? RVX, Russell Vol, it's still above 30, 33.2. It's very high, right? So, and it doesn't feel like people are too scared, right? We're switching back to risk on. There are some good bullish developments, but I tell you, it's going to be some interesting stuff in today's charts that I'm going to show you. Let's hop into the sector analysis really quick. First and foremost, how did the week finish out? Right, so we were down so much, and we came all the way back to be positive on some of these on these indices. But look at the top performing sectors. Okay, healthcare, real estate, utilities. That to me seems defensive. Does it seem defensive to you? It should be. And if it doesn't, well, just understand utilities is a defensive sector. These are more defensive in nature. What was at the bottom? Well, we had financials, we had consumer staples, and we had consumer discretionary. Consumer staples is also a little bit defensive. It ended up around flat for the week. So interesting stuff overall. Let's go ahead and go to the rotation chart. I'm going to be wrapping this all together too for us. Energy still on a 4-week tail length, still is that big leader. Now, I want to call this out. Every single trader, investor already knows that oil stocks are the leading stocks, and there's some great setups, right? There's some that I share on my Discord today, and there's a lot that are on my watch list, and I don't want to dismiss that because they can still play. But understand, when all eyes are on one trade, where is the next trade going to be where all these eyes are going to all of a sudden turn to? And that I'm going to talk about in today's episode about some interesting stuff I see taking place. And understand, these are just opinions, all right? Now, these opinions are also based off of factual data and charts, but it doesn't necessarily mean that I can predict what's going to be taking place in the future, right? We deal in probabilities looking at technical analysis and intermarket analysis. What else do we see on the rotation chart? XLP, defensive, right? Utility is kind of coming down, but we're still in the leading quadrant over here overall. The big notice here are these big guys, consumer discretionary and XLK. They are in the lagging quadrant, and then technology is in the weakening quadrant, heading itself into that lagging quadrant, which it could very well be there in coming weeks. Let's take a look at the weekly charts to see how we did in the indices. Obviously, huge rally from that 410 low in the SPY, okay? RSI is still under 50. We still have wind at our face as the market's pressing up. Huge hammer candle. That's what you're going to hear a lot of technical people talk about. Huge hammer candle. Bam, if we get above that, we can head higher. Yep, I would agree with that. Absolutely, but we're going to talk about key levels. Understand we're still below, right? What did we say on last weekly recap? What we need to see is the weekly close above the 5-period EMA. That would tell us that there's at least the bulls back in control. So the bulls, they're not in control right now. Okay, so that's just how it goes. It looks good, but we're not in control. Qs, still under that 5-weekly EMA too. Need to have a weekly close above it. Are they in control right now? No, maybe next week. But understand we're below that. We're below all these key moving averages. I think pretty sure we hit that bear market actually on the low there, and where RSI is still below the 50 level, and wind is at our face there looking at that PMO. Let's continue on to the IWM. And understand too, which is still crazy, is we were down significantly, but we still managed to finish up 1.25% there in the Qs. IWM finished up 1.52% here as well. And you can see we had this little double bottom right here, and we started rallying, just rip your face off rally, which happens in bear markets, right? You get these rip face off rallies, but understand we're still below this very long period of consolidation, this trap supply up here. Can we head higher? Obviously, we can head higher. The PMO, wind is at our face, but it's starting to flatten out here, which is a positive sign, but we're still well below that 50 marker on the RSI, so still a little bit of hesitation there. Dow Jones, monster hammer candle right there. Where are we? Well, we're still below all those key moving averages. We still have wind at our face. It's still pointing straight down. RSI is still below 50. So as people are getting very excited about this rally and jumping into it, understand there will come a time where the selling of puts dies out. All right. And I'll prove it to you today that we still are in the midst of a lot of volatility. Actually, I already showed you that by looking at volatility charts, but let's look at expected moves or the risk ranges. All right, so what is coming into next week? So first and foremost, last week we closed within the risk range. We talked about that. What do you know, right? It happened again. It happens. What did the Theo team say? 68% of the time, it should end within that area. Now, what do I want to call out here? Huge risk range once again. Volatility is still here. We are still swimming in an ocean with gigantic waves. All right. So if you're not equipped to surf these type of waves, don't jump in these waters. All right. It's a very, very difficult environment to be a part of. Not great for swing traders, great for day traders, especially if you know how to look at order flow and manage, risk well, I guess I should say. You should know how to do that all the time. But we have a 12.84 plus or minus expected move. So that can take us up to around 450. And that right there is still below a declining 5-day moving average. It's right by all these candles. I think that's possible. All right. So what I've been doing recently is I like to predict whether or not we're going to see maybe a higher high, higher low, and so forth. And so far, been doing pretty good with that. And I want to just call out on today's or on this last trading day candle, kind of what I'm expecting to see potentially going in just on Monday, and then we'll follow up the following day. But this was just a monster close, right? So a high is right here. I would think that if we don't get some crazy gap down on some news event, I think it's possible that we'll put in another higher high, and I think we'll put in another higher low. So the candle could look something like that going in onto Monday. I don't know if it'll be that low or not, or what will take place, but that's what my guess is given the context and power of this move. I think that there's still, it can reach a little bit further, potentially even to this 200-day moving average. Now understand that is a lot of volatility. A lot of things can happen in this week, okay? Let's move on really quick to the next risk range expected move for the Qs. This is pumping in even more volatility, right? So 12.34 expected move, but on a less expensive product. So what does this mean? It could take us up to just below 360, which is right by all these previous, resistance, or sorry, support, and then resistance right here. So it can take us up all the way here. If it takes us up all the way here, right, that's going to suck a lot of people in. I guarantee it's going to suck a lot of people in. You know why I know that? Is because that type of move is a very large move, and it's going to draw on a lot of attention. You're going to see on the headlines, markets starting to recover. Is this the time to get back in? Things are looking great again, et cetera, et cetera. Okay, that's what's going to hit the news headlines. But what we know is that's the upper edge of that risk range, and we need to be very careful, and we're still below these key moving averages. So there's still a lot of trapped supply up there that can be dumped out. So be very careful. On the lower edge of this will bring us potentially right back down to this lower range, this January low. So we took that out. I want to call out, what do you notice going from 2022 so far? What do you notice with the highs and the lows? You probably are saying, well, we have lower highs and we have lower lows. You're correct. So why would you fight that trend? All right, I understand if you're trading it with intraday or if you want to take some overextended areas, that is completely fine. Just understand that a big move straight up, those will digest and they can easily get faded, especially when we see this type of volatility. Okay, this is not a bearish prediction or a bullish prediction. This is a be careful prediction. All right, now if we do draw a line out down from here, this is very similar to the SPY. It is have this, lower high, lower high, lower high, lower high, and we have this down sloping trend. So we could potentially break out of it and then hit this upper edge and then maybe pull back a little bit. That's a possibility. We'll talk more about that on the daily briefs coming into next week, but just understand pretty large risk range overall, well below those period moving averages. IWM, understand the upper range here on IWM is right at about 210. And what does that mean? Well, that's right back to the lower breakdown zone of that really year-long consolidation. So we come up here, that's up to a declining 50-period moving average, and that in confluence. Understand this is not an environment that you just want to short right here, or potentially maybe even short right there. You need to look either intraday or some smaller candles or even daily candles to show sellers stepping in, right? I'm not going to step into a candle with a shaven head like this where it's full bull mode and then just short it, right? It doesn't, you can get lucky, but there'll come a time, if that was your strategy, there will come a time where it will blast off and just rip your face off. All right, so you need to put risk to reward. You have to think in terms of risk and reward. Where can I get the most reward for the least amount of risk? And in order to do that, like for example, right? Now I'm going on a tangent, but do you see this hammer candle right here? Inverted hammer candle, right? This long upper wick as it came up into this previous area around 210. And then if you were to just say, okay, if it starts cracking down through that, that would be a good area to short. And I would agree, even if you didn't see all this data right here, I would say, okay, cool. Yeah, that's an area to short. Now, where would you put a stop? Well, I would put a stop above that candle high. All right. And then what you would see happen, pulled down, it came back up. You might have been scared right here. Oh, should I just get out? It looks like it's going to stop me out. I'm losing money right now. But if you just held to your convictions, bam. All right, and then if it was a move quite like that, that's a pretty explosive move. I would imagine you'd be taking some profits on a crack like that. And now you start to see it come up, right? Where would your stop be now? If you just stayed in the position, well, your stop would probably be a little bit lower, right? You would move your stop down to, as you put in a lower low, you would move your stop down to a lower high. And now we're starting to see that explosive move. All right, I'm going on that tangent, but let's continue on. All right. This is where it gets interesting, folks. Let's look at bonds and yields and then commodities. And commodities section, I have some bonds and yield stuff there too. So first and foremost, we're going to take a look at the curves. Curves. 10 and 2, very important when it looks, we look at this to potentially invert, right? Where are we at? We're at 42 bips, okay? The lower this goes, means it's good. The closer it gets to zero, that means we get to inversion. And when we invert, and we hold down there for a few days, couple of days, 10 days, 12 days, whatever the case may be, the longer you hold, the more indication that there could be a recession in the near future. And it's been 100% accurate. 30s and 5, 0.43. Okay, so these are flatter than a pancake. And we're coming up into the Fed meeting. All right, what is the Fed going to do? It looks like they're going to be raising rates. All right, it says basically the probability right now is 100% chance of a rate hike. There was a higher probability at a time where they were going to raise it 50 points, but the futures market has dropped that down to a higher probability that there will be a 25 bip hike. Okay, so we will see if that is what takes place. Now, what leads up from now to that meeting? A lot can happen. And we don't know if this can even invert by the time of that meeting. I'm not predicting that to happen, but just understand we have a large range here between all the yields, and you can just see if I just keep drawing lines, do you notice them contracting, right? What does that mean? It means the curves, they're flattening, all right? Boom, they're getting tighter and tighter and tighter, which means these head down and they could potentially flatten more to invert, so we need to be very careful. If we take a look at the TYX, this is the 30 here. This thing looks like it has the possibility and potential to rip. And that we need to be very careful for, right? We talked about the 10-year yield looking like this at a time. If the 30-year yield wants to start ripping, that will apply significant pressure on the equity markets. All right, so I'm not going to predict for that to happen, and we'll talk more about specifically of some interesting things that I do see taking place. But understand, if this does pop off, we can very well see some very interesting things take place in the equity markets. And then not necessarily, if it just moves up slightly and slowly, but it's the rate at which it moves. It's what shakes things up. Okay, so now if we look at the 10-year yield, we did talk about this before it broke out, and it broke out. We're starting heading higher. It's starting to reach back at to that 2.0 or 20, I should say, right? It closed at, where did it close at? 19.86. What does that mean? It means the 10-year yield is at 1.9, okay, is what that means, 1.98. It's almost 1.99, almost 2.0. And we know this, when this fires off and heads higher at a rapid rate of change, it puts pressure on tech stocks, and tech stocks make up a big portion of the SP 500. So when we fired off here, I mean, in 2022, right? Boom, boom. What happened? What's happening so far this year, right? The equity markets have been taking it on the chin. All right, so this is where it gets interesting. Let's take a look at some commodities. You may or may have not noticed what took place last week with commodities. Now, there's a lot of geopolitical risks out there. All right, but this could have been priced in, and now we're starting to see a subtle change as far as price action goes. Okay, let's hop into this. Now, these are some soft commodities. We'll also hop into some oil and some other various stuff too as well, but soybeans, look at that weekly candle. That to me looks, quote unquote, blow off toppy. All right, it looks very like an exhaustive move. So a very explosive move, very bullish candle all the way up, right? So at one point, this was a big green candle, big green bar. And then all of a sudden, it reversed completely on itself and closed pretty much at the low. All right, and if we look here, boom. Last time we came up this area, bam, we started to head down. So there's some supply up in this range. So if we start getting down further, it doesn't mean it's going to be all in one quick hit or anything, but just pay very close attention to this because it all makes sense here coming up. Take a look at wheat. This also was a very explosive move to the upside, and don't quote me on this, but I'm pretty positive wheat is like one of the biggest exporters is Russia. Don't quote me. I think it was wheat. I could be getting confused, but check this out. Explosive move to the upside, completely reversed on itself. A lot of volume on that explosive move to the downside too. So this kind of looks like it could be potentially an exhaustive move, right? I don't know if this is just happening because of the geopolitical risks and if it can change, but just understand that if price does start getting below that low and start closing a weekly close below there, could be some further downside action in this commodity. If we take a look at corn, I've been a big proponent on corn for over a year and a half, maybe even longer, and I love the chart of just ticker symbol CORN. However, if we take a look now, the weekly candle, that is one ugly, ugly looking candle. So if we start getting a weekly close below that and it doesn't recover, that could spell some more downside in this commodity itself. And I promise I'm going to tie this all in. Oil, explosive move to the upside, and it reversed itself. Weekly candle does not look good. Shooting star type candle, right? Another inverted hammer. We're starting to see some similarities here. Now, I do think that oil can go a lot higher, but I don't think it's going to be going up a lot higher in a straight line. So it could be a point in time where we might start to see it back off a little bit. We need to get confirmation, but just understand, I will point out, so it's been in this straight vertical move. Perhaps we pull back and we start, retrace 50% of this, from low to high up here. That would be, around $77 to $80, on the price of light crude. Now, let's keep going on. Silver, ugly looking candle, right? We broke above the 200 day. I've been saying, I would like to see it digest more than rather just seeing it completely head up higher. And it didn't really do that. We had this explosive move, and then it got completely reversed. Okay, so are you seeing something? Are you seeing, what I'm showing you here? And I'll point out why it's important. Gold, similar, right? We had this explosive move, right? We traded at a high of 1976, and it reversed itself, creating a shooting star type candle. And you can see it's closing back below that move right there. So doesn't mean that it's down and out. That's not what I'm trying to say. What I'm trying to do here is wrap and tie everything in together and why it's important to understand this from an intermarket perspective. So if we get a weekly close below the low of this candle, 1878, that could spell that we might be in some more of a downside, maybe come test back to 1800 or even continue to just trade sideways here. All right. Now this is where it gets very, very interesting. All right. The CRB index. The CRB index is, comprised of a basket of commodities, energy and oil being the largest component of it. Okay, if you don't know the components, I actually made a cool little short video about the CRB index a while ago, or maybe DBA. I forget which one it was. The reason CRB has been doing so well has really been driven a lot by the price of oil. And what I'm calling out here is another shooting star type candle. And now you're going to be like, well, what's this chart up here? USB, bonds. Okay? Understand this from an intermarket perspective. When commodities, when they fall, bonds typically do better. That's an interesting correlation to pay attention to. So for example, in the pandemic, bam, commodities fell off a cliff. What did USB do? What did bonds do? Kaboom! Fired off. All right? Take a look here. Well, when they started backing off, boom, what did CRB do, right? Boom, started heading higher. And what are we seeing right now? Well, we're starting to see CRB obviously go completely vertical. And what did we see bonds been doing? Bonds been breaking down, okay? And now they're coming back down into this area. So why am I pointing this out? Well, it's very similar to what I've been saying on previous episodes about looking at the TLT, the TMF, which is a leverage fund, all right, for bonds. If this starts, if energy or if commodities, the reason why I'm showing you this is because all these commodities, these weekly candles, they have the potential to start reversing. Doesn't mean that they're going to, but it has the potential to. So if you're going to, if everyone's looking at all these oil stocks right now, but really we're coming into a period where oil or energy or, various commodities are going to start backing off, that could signal that we might be seeing movement higher here in bonds where the CRB index might be taking a breather and no one's actually keeping an eye on that right now. I mean, I'm sure that there's intelligent, very smart people keeping an eye all the time on this kind of stuff. All right, so I wanted to call that out. If commodities, are going to start backing off, it definitely seems like the bond market might be a place to keep in mind. Now, what is important to note also is the relationship between the ratio between bonds and the CRB. So if you actually look at this chart, this is dividing CRB, USB. This is a relative strength line, okay? The relative strength between commodities and bonds. This is a weekly chart dating back to 83. And the reason why I'm doing that is to show you broad context. When the line goes up, that means commodities are performing better than bonds, okay? What do you notice? Well, I notice this. Commodities have been outperforming bonds. Now we're starting to see weak candles. So I say, okay, well, Where are we in the relationship with one another on this RS line? Right here at 1.8, notice how it was support here, support there, support there, support there, and when we broke down, we started heading a lot lower. Once support is broken, support can become resistance. Look at, I mean, if you put all the pieces together here, I'm not saying it's going to happen in a snap of the finger, but it definitely looks so far that if this does start turning around here, all right, that means bonds are going to start outperforming commodities. It means commodities, what we're seeing on these weekly candles, which could be potentially blow-off type candles, all of a sudden now bond market starts moving up. But what does that even mean for the stock market? Well, did you know this? Here's another chart. This purple line is the ratio we just went over, right? That it's just purple now. When bonds outperform the CRB, all right, that means when this line goes down, defensive names are typically stronger. And by defensive, typically stronger, what I mean is in relative to the S&P 500. So for example, I put XLU over SPX. And what do you notice here? When the CRB index is falling, not necessarily falling, but when the relative strength line, when the CRB index is outperforming bonds, there we go. As meaning this line goes down, what do you notice between the relationship in utilities and the S&P 500? They get stronger. So when this line goes down, defensive stocks are where to put your money. When this line goes down, defensive stocks outperform. Now, this is a relative strength line, so it doesn't mean that utilities are going sky high by any means, because they can go down too. But if you're looking to protect capital, this would technically go down less if everything's going down, okay? Now, why am I pointing this out? Well, first and foremost, I mean, look at this. Look at commodities been outperforming at a very rapid rate. Now we're running into that 1.8, which has a clear history of support, and it could be potentially become an area of resistance. And as this was running up, the relative strength line between utilities and the S&P 500 been going straight down. So you tell me, if that resistance holds and all those candles play out to be bearish, where do you think would be the safer place to put your money? It would be, in my opinion, utilities, maybe consumer staples, and bonds, right? The TLT, so there's, actually, let's just wrap it into the conclusion because I think you get my point now. All right, so TLT, you got SHY, you got XLU, you got XLP, and I'm sure that there's more. But to me, if we start getting continued weakness in the CRB index and these various commodities, I do believe that we're going to start seeing a more defensive posturing take place in the markets, which is very similar to what we saw this last week. Hope that helps everybody. Have a wonderful weekend.